keep most of the downside while capping your upside at the strike price. This means that through any periods of market volatility, which are of course common in equity
You're going to have
stocks,
all the
you
downside
eat
risk.
most of the downside, but you do
Right.
not participate in a large portion of the upside. Systematically missing out on stock market recoveries, which are common after major downturns, can be very expensive. I want to make sure it's really clear that the point about asymmetry is particularly important for long-term equity investors who have historically benefited from a little bit of mean reversion in stocks, making stocks a little bit less risky at long horizons than they would be if returns were completely random.
We saw this in April 2025.
This is in contrast to bonds, which do not tend to have the same rebound effect after poor performance. But here's the problem. Selling calls on your equity positions both lowers the expected returns and eliminates the mean reverting tendency of stocks by capping the upside return, while only slightly improving the downside by the amount of the option premium. I would argue that it makes covered calls very risky for long-term investors who are concerned with funding their inflation-adjusted spending.
Yeah, I agree.
Lowers expected returns and transforms the shape of the distribution of returns into something much less favorable for long-term investors.